Hello everyone, a very good evening. Today being 28th of November, 6:40 p.m. Indian Standard Time and 5:10 Dubai Standard Time. I hope you all had a great morning and a great evening. Yes, the markets have concluded for today, but this is when we would be shifting our focus from providing you with hot stock recommendations to education, right? Education pertaining to technical analysis. So let us start today's live trading session, third live trading session, by introducing myself. I am Harsh. I have 8 years of trading experience. I have been trading the forex markets, the commodity markets, as well as the US based indices such as the S&P 500, the Dow Jones 30, and the Nasdaq 100. Currently, we have been also looking at the Indian share market, whereby we analyze the blue chip indices and identify trading opportunities in the individual share markets. Since I provide you with um, 5 days of live streaming sessions all the way from Monday till Friday, with each working day with three live trading sessions. The third live trading session is dedicated for me to provide you with more information from an educational perspective towards technical analysis. We would be also covering the psychology that is behind every traders, every investor's mind, because a huge proportion of trading, financial trading, relies on psychology. There is a saying that I'd come across that had that was something similar like this: trading is 90% psychology and 10% mechanical. We will get into the topics more in detail, so we will talk more about technical analysis and also covering up psychological aspects as well. So I hope everyone is present for the session. Like I was telling you, I am Harsh. I have 8 years of experience, so I have been blessed to be a part of a community which were basically conducted by people who used to work as flow traders on the Chicago Mercantile Exchange. So it has been a privilege and opportunity, a blessing in disguise for me, where I could learn, so much and gain so much of value from people, from such bright-minded people. I am more of a technical trader, as you all know. I specialize in technical analysis such as supply, demand, price action, order flow analysis, swing analysis, wave analysis, and Fibonacci retracement analysis. Here, we at Dolphin Markets are doing our best in terms of providing you with high value content, correct content in terms of analysis of the share market, analysis, then hot stock recommendations and education. So with the third session up and running, we will be focusing our shift and or shifting our focus from the Indian stock market in terms of providing you with hot stock recommendations and focusing more behind the psychic, as well as covering up the advanced technical analysis. As you are all aware, since the beginning of the week, we have been, for this particular third live streaming session, we have been focusing more on the various stages of technical analysis. So Monday was generally occupied with basic. Tuesdays when we had covered with mid-level. Wednesday, for some reason, I was not able to attend the live streaming session. So nonetheless, today being Thursday, today where we will be covering up with advanced technical analysis, correct? So let us come and look at the PPT which we will be talking more about. I will be talking to you a lot about advanced technical analysis on the PowerPoint in terms of the explanations. Then we would jump back to the charts where we would be analyzing, evaluating the charts based on the content that we would be learning today, and we would be following that particular procedure. So let us start with technical advanced strategies, right? So first and foremost, when it comes to technical trading strategies, you have to bear in mind, and it's very important that everyone should be aware, the market is moved by big banks, institution, financial intermediaries who have a lot of capital. So they are basically categorized into two compartments or two sectors of groups. The first sector being FIIs and the second sector being DIIs. I'm pretty sure everyone has been hearing the terminology of FII and DII quite often, but to those who are new to our live streaming session, to all of those, it's very important to have a quick understanding. So FII is a foreign investment institution, right? Investors who are investing in India but are not from India. They are coming from abroad and setting up their businesses or investing in India, correct? So, and these are the examples such as JP Morgan, Euro Pacific Growth Fund, Morgan Stanley. So basically, they are foreign investors who have come to India to the local markets and are investing in the local country. In terms of DIIs, domestic institution investors are basically Indian, so local investors who want to profit by putting their money in the Indian stock market, correct? So they can put it in insurance companies, mutual funds, liquid funds, and other investments. Now, these are the other examples as well when it comes to DIIs. I hope everyone can see my screen, correct? Yes. So we have ICICI Prudential, Nippon, HDFC Life. So simple terms, FIIs are investors from foreign who want to invest in the local Indian markets, and DII being domestic are the local investors themselves who want to take the opportunity to make money in the financial markets, correct? A small distinguishing a couple of points between FIIs and DIIs. So in terms of location, FIIs are foreign people and DII are the local domestic parties, correct? Limitations, FIIs have been given a regulation where they can only invest up to 24% of the amounts paid up capital, right? When it comes to DII, there is no such restriction because they are domestically based, correct? In terms of holdings, FII holds around 21% of the overall holdings in the companies that make up the Nifty 500. DIIs are holding less, right? Only 14%. No matter, even in terms of this, it is a very crucial point to keep in mind that with the size, with the percentage of 21 for the FIIs and a comparatively lesser known size for the DIIs 14. So whenever there is fluctuations in the market, it is generally the FIIs who are at play, correct? Most importantly is the last point, which is investing style. Foreign institutional investors invest with a focus on short term to medium term. So, with the corrections that are taking place in the Indian share market, with almost 11 to 12% correction all the way from October, the reasons have been because of the FIIs pulling out funds or booking profits and parking their funds into other economies such as China or USA where they can get better returns. So they are basically focusing on the short to mid term trajectory when it comes to profits, or keeping their or parking their funds. When it comes to domestic institutional investors, there is no such time period because majority of them are coming with a focus of long term holding or long term investing, correct? So these are some basic points. Now let's start with the main topic in terms of advanced trading strategy. Everyone is aware that the stock market is a zero sum game, or in general, the financial markets are a zero sum game. There is a one way in and a one way out. What comes in has to get out, also at point, right? So, perfect. So if someone is making, someone is losing, and if someone is losing, someone is making. So first and foremost, we have to be aware that a lot of people who might be having experience, even in the group, in our community, you would be aware that many times you have taken trades in the past where you have placed entries and you get stopped out only for prices to return back into the direction. So this is very common in trading, and that is one of the reasons, one of the main reasons for it happening is because of a concept called as stop loss hunting. So let us have a quick understanding of this particular concept, and then we will look at the charts as well. All right. So stop loss hunting is a type of trading strategy that aims to profit by deliberately triggering other traders stop loss, right? And certain points or concepts behind stop hunting are key technical levels wherever people are expecting or there is a major consensus for people to place their stop losses. There is a general tendency for the big banks or the FIIs and DIIs to to manipulate prices by hitting other people's stop losses, right? So one is key technical levels, the other one is order flow. Maybe there might be a huge order flow at a particular level, and because of the volatility or due to certain market conditions, the prices can create long wicks, and that also results in a lot of stop losses. Sentiment and news analysis. So these are some of the points which one should be thinking about when we are talking about the concept of stop loss hunting. Let's have a first a pictorial representation of what exactly stop loss hunting looks like, correct? So we have a particular chart given. Whether it is any chart, it does not make a difference since we are focusing on technical analysis. We want to focus on the concept behind. So irrespective whether it is the E-mini S&P 500 or whether it is Nifty or whether it is Reliance or whether it is D-Dave Plastic or whether it is today's hot stock recommendation that was given, right? We had provided you with two hot stock recommendations, one on Arctply and the other one on GGBL. So, right, any stock that can come in your mind, but please understand the concept, right? What we are talking about. The blue color line denotes where people would have entered, and plus minus right a couple of points below the blue line is where people would be like, all right, this is where I plan to enter, and a couple of points below that, this is where I plan to put my stop loss. Prices manipulate that area. So generally, people are right in terms of direction, but people are wrong when it comes to putting their stop losses. And that is the reason why many traders who take trades or investors who are placing trades, they do come across a lot of times where prices go and hit their stop losses for eventually prices returning back to their favor and going in their desired direction, correct? So this is a pictorial representation of stop loss hunting. The other one that we are very commonly able to spot on the charts are such scenarios where we have a horizontal trend line. It could be a resistance or a downtrend line or a support or a bullish trend line. It could be a channel or it could be a pair of trend lines, right? Whether they are consolidating or constricting or diverging. What we are trying to say here is based on the picture on the illustration on your screens, the upper trend line, correct, the bearish trend line with points touching the trend line at point number one, point number two, point number three. So when you have more number of touches on a particular trend line, the general consensus for a lot of investors and traders is that the trend line is holding, so the trend line is strong. The more number of tests a particular trend line has, the higher the probability of the trend line to hold. Point number four, right, is the time when people with the consensus that yes, since price was held at point number one, point number two, and point number three, there should be a higher probability for prices to hold at point number four, correct? It all boils down to the basic concept of trend lines and its functionality. So at point number four, as you can see on the screen where my mouse is the time when the phenomenon of stop loss hunting takes place, correct? When prices go against the consensus of in this particular scenario, the major consensus was that prices should have held the resistance trend line and should have continued low. Did it continue lower eventually? Yes, it did. But in terms of the manipulation that has taken place, correct, that has to be of importance because certain scenarios keep happening on a regular basis, correct? So we are first of all talking about the concept, and then we will try to evaluate it on the charts as well. So point number four, point number five, right, these are the areas when there is a likelihood for prices to keep having stop loss hunting. Since I had explained to you, the market is a zero sum game. What comes in has to get out, right? If someone is making money, someone on the other corner is losing money, right? And if someone is losing money, someone else is making. So such phenomenons are called as stop loss hunting, where prices are manipulated for it to return back eventually into the direction where the majority of traders eventually wanted it to go, but only after getting stopped out. All right. Now let's look at the second concept, which is basically market manipulation. The first one was mainly towards stopping the majority of traders and investors at particular key levels, correct? That was based on stop loss hunting. But market manipulation, though the concept may sound similar, has a different purpose on its own. So, market manipulation is again the attempt to artificially increase or decrease the price of a security, correct? So, it is trying to attempt to skew supply and demand to push the price in a favorable direction. So, let us look at some examples. As you can see, with the general consensus of resistance, because everyone is aware about supply, demand, resistance, support, double top, double bottoms, triple tops, triple bottoms, head and shoulders. Every technical trading textbook has examples of the mentioned concepts and strategies, right? So with that keeping in mind, when a particular resistance, or a bearish trend line is observed, people will have a tendency, all right, now it's coming to an important area of resistance. Based on the charts, you can see the prices, when they came for the second time, they started to hold that particular level, right? The resistance that has been mentioned had been holding. The third time when prices are coming to that area of interest, the sellers are placing their short orders, correct? Since the resistance held, since price was held by resistance at 1, 2, and the third point at which price was currently being at, the general consensus would of course be like, yes, if prices have been held at resistance for the first and the second time, for the third time it should hold it as well. What happens eventually is the prices get manipulated by prices closing above the particular resistance illustration in this example, and people who had taken shorts are panicking now. Either they are panicking and closing their trades, but at the same time you have another category of traders who are called out as breakout traders, right? When a particular key area of resistance or support is taken out, it leads to people taking trades who are basically known as breakout traders, correct? Now when those breakout traders are entering and the people who are taking shots are closing, again the market manipulates. So first and foremost, the people who had taken shots around the area of resistance were stopped out. People who had entered based on the breakout strategy had taken long. They are also panicking and are closing trades or are getting stopped out. So there is a lot of manipulation that takes place. Eventually, the prices were continuing lower. So who were right? The people who had taken short at the resistance were right, because it did hold it in the past, but the only caveat is that there was manipulation around that area. The prices went above by the concept of market manipulation, and then the prices turned and returned back to the direction that people had eventually, thought of happening. Now let us look at another similar example to get a better clarity when it comes to market manipulation. Similarly to the resistance mentioned, the prices had held resistance not once, not twice, but almost thrice. Next time when the prices close outside, first of all, you might have people who are taking trades again at the resistance. They might start panicking, but now you have people who are like, all right, now there's a breakout taking place, so prices should continue up, only for prices to again manipulate. So we keep talking a lot about flip zones, correct? If a resistance gets taken out by a candle, the resistance gets converted to a support and vice versa. So people who were thinking it on a similar basis, right? Yes, the resistance was holding, now it should be going up. So now it's created a support and the support shall be holding. So the people who had taken short at resistance, they are panicking or they have been stopped out, as well as people who had taken trades based on the breakout, they have taken trades and now they are also panicking. Why? Because prices are going sideways. For prices to eventually reverse and continue down, this has been happening more commonly in the last couple of years compared to when the markets had been established, long time back. With more players into the market, with more freedom given to the retailers in terms of taking trades, um, the market pan manipulations and similar concepts have increased drastically, right? Because since the markets have been based on a zero sum game where anything that enters has to exit, so there has to be a lot of stop outs for people, for the FIIs and DIIs to generate liquidity, right? Because eventually the gameplay is based on supply, demand, and price liquidity, correct? Now, before we continue, it is important to understand. I was talking to you about advanced technical concepts, right? We have talked about the basic and mid level. We have covered trend lines, channels, Bollinger Bands, moving averages, RSI, double tops, double bottoms, continuation patterns, reversal patterns. We have even talked about which other super trends. So we have covered so many strategies and concepts when it comes to technical analysis, right? With today being focused on stop loss hunting and market manipulation. But please be aware that these trading terminologies, these trading strategies are important, no doubt in that. But what is more important than strategies is the psychic, correct? You need to have the mentality, you need to have the psychology to, because the market runs only on two factors: greed and panic, right? Greed and fear. So when people are panicking or when people are greedy, they are they are not in control of their emotions, and when people are not in control of their emotions, things start to go haywire, correct? Things start to get mishapped, and a lot of people start to fall into a lot of problems because of this factor. So even in trading, it is not much about trading strategies. I mean, everyone can learn about trading strategies online via Google or going to a mentor or coming to these live streaming sessions, correct? But we are also emphasizing on the psychic behind trading, the psychology behind trading, right? So let us cover some key points which are very vital when it comes to the field of trading, correct? So first and foremost is to understand the market before you start trading. Unlike any other business or any other field out there in the practical world, you cannot enter something that you are not aware of. Many people have come across in the past have been like, Harsh, I've taken a trade on this particular stock. I've taken a decision to buy this car. I've taken a decision to buy that house based on impulsiveness. So that is the biggest concern. People need to understand that, all right, is it necessary? Do I have a full understanding of that particular subject or concept? I hope you get the point. It is important to be very well versed with whatever you are planning to enter into. And the same holds true for financial trading. All right. So you need to be clear in terms of understanding the market before you start trading. Lot of people, especially in the financial market, start to take trades with the greed of making money. Remember, making money is a byproduct of trading. If your trading is good, if your strategies are good, and um, if your psychology is strong, you will eventually make money, right? Money is not the end goal of trading. Money is the byproduct of trading, right? Trading just requires discipline, consistency, good psychology, and that's it. There might be people who might be having or who might be using basic trading strategies, but could be making much more compared to people who are using very advanced high level strategies but cannot be making money consistently. Why? Because it all boils down to the psychology, correct? So we will be covering more points in detail. So first, understand the markets before you start trading, whether it is market terminology or the unique traits of the market or the factors influencing price movements, whether macroeconomic, microeconomic, news based, panic based, or geopolitical concern based. So the trinity, as you can see, based on the circles, the more concepts or the from more angles that you are able to understand, review and see for yourself that yes, we have covered different topics. I've understood this particular market from fundamental point of view, I've understood the market from a technical point of view, I've understood the market from a sentimental point of view. The more number of circles or the more number of angles that you are able to cover a particular subject, in this case we are talking about trading, correct, the stronger or the better informed or the high probable your trading output will be, right, in terms of making money. Second, we are going to be talking about determining market conditions. There are always going to be like a cold war that keeps taking place between fundamentalist and technical traders, right? So fundamental traders are those people who take decisions based on balance sheets, income statements, cash flows, with the number crunching. They love numbers, and people who love numbers generally they tend to drift towards fundamental analysis. On the other hand, people, including me, who are more creative, who are more imaginative, who love using tools to draw, to analyze the market. We love using technical analysis. But having said that, someone who is purely into fundamentals or someone who is purely into technicals, these are also not good signs. We should always be having a complete approach when it comes to trading. It's never to be better. There is a saying, but it's changed, and it's the saying used to go like this: it's better to be a king in one field rather than being a jack of all trades. But with the current circumstances, with the improvisations that have been taking place in the world, it is better to be a jack of all trades than to be a king of none. So it is very important to keep in mind that utilize the best usage of fundamental analysis, technical analysis, and I would even add sentimental analysis, right? What is the overall sentiment in the market to your advantage? Because the more number of angles that you are able to preview a particular market or a stock, the better the chances for you to thrive and make profits, correct? So it's very important to understand fundamental analysis, which could be company analysis, industry analysis, economic conditions, future profit outlook, or technical. It could be different, either indicator based or price action based or concept based, such as supply demand or price action or order flow analysis, correct? Then assessing your risk appetite. This is another point which is very important, because many people they tend to avoid or skip this particular step. You need to be very, very, very well versed when it comes to assessing your risk appetite in terms of, are you a conservative, do you have a conservative approach to risk, do you have a moderate approach to risk, or do you have high tolerance to risk? Many people are not even able to understand this basic concept, and they just want to enter into trading with the hope of making money. Remember, trading is always based on probabilities. Trading is not based on certainties. So how can you enter the markets without having the right set of information, expecting to make money? It is not possible. Can you make money once in a blue moon? Yes, probably, but you will not be consistent, correct? So it is very important. People need to have the right set of information, whether fundamental, technical, sentimental. People need to be aware of all the market conditions around that particular stock or index, but also very high importance to be given to risk. Person who is very jittery, who's very scared of losing money, cannot be having a high tolerance risk. On the other hand, if someone really has that push towards going for high risk products, you need to be able to balance it out. This is what I feel, correct? Make informed decisions that you can take based on the information or based on the vast amount of information that you can collect, correct? Then we are looking at risk to reward. Now, this is again a very important point to keep in mind, because generally people who are started to take trades, or who have been trading for a couple of months to a couple of years, All they care about is how much of money am I making. But a lot of us are not focused on how much I'm risking to how much I'm making. This is a very important concept. When people talk about, Harsh, I made maybe $100 in one trade. I made $300 in one trade. I made $1,000 in one trade. I made $10,000 in one trade. The first question that I ask to my viewers and to my clients are, all right, but what was the risk that you had associated that particular trade with? And we were not aware of that. And that is very risky because you need to have a clear idea in terms of, all right, am I risking a particular percentage to make an X amount of reward? That is the most important criteria, correct? So the risk to reward ratio is very crucial. How much I'm willing to risk to how much I'm willing to, get rewarded for that risk. If people are able to understand this concept, you would be far ahead of the curve, right? When it comes to financial trading, the less you risk in term, I mean, the less you risk to make more of reward, they are generally considered to be high probable, and these kind of trades will help you be consistent. When someone asks me, Harsh, do you even have losses in trading? And I'm like, of course, who does not have? We do not have a crystal ball in front of us telling us that, all right, Harsh, this stock will do this, or this particular forex pair will go in this direction. I wish it was that simple. And if it was that simple, everyone in the financial markets would be rich, would be making a lot of money, correct? But that is not the case. Majority, on the contrary, majority of people are losing money when it comes to the financial markets, correct? So people need to start thinking proactively, correct? The trades should not be taken based on impulsiveness. The trades need to be taken based on clear and structured decision making process, correct? Then we would be talking about documenting your trading plan. Trading plan, again, overlooked by a lot of traders, including me, during the initial phases of my trading career, where we were young, we were hot blooded, we were like, we want to make money, we want to make as much of money as possible as of today, right? Generally, everyone who enters into the financial market is coming with that perspective in mind. I'm pretty sure everyone in this group would be having, a laugh at this. But tell me something: how many people in this particular community are entering into the share market or the financial markets with the aim of losing? Come on, I want you to type in the comment box and let me know. All right, I will not even get a single answer, correct? Because the answer is obvious. Why will anyone enter into the financial markets to lose money, correct? Everyone, I'm telling, if there are 100 traders out here, all the 100 traders or investors will say, of course, Harsh, we are entering the markets, we are taking trades to make money. Then why do people, majority of the people, lose money in the financial markets? It is a question to think about, correct? When everyone who is entering into the financial market is coming with the aim of making money, then why are majority of the people in the financial markets losing money? It is a very important question to think about. And I hope this starts to ignite a fire of curiosity in your brain, telling you that yes, Harsh is very correct, and we should start thinking about all the factors and not just about clicking the button and taking trades, right? That is okay, that is what everyone does, but how can you be different? Because being different, being clear with a plan, being clear with your risk appetite, being clear with your fundamentals, technicals, and sentimental analysis can put you, way ahead of the graph in terms of the other people. So when it comes to documenting your trading plan, it's very important to have a detailed checklist or a trading plan that includes your strategy, your favorite pairs in terms of trading, or your favorite stocks, your psychology when it comes to trading. Are you more of a are you more into intraday trading? Are you more into day trading? Are you more into long term trading? Are you more into investing? So there is a lot of different categories, that right? Everyone is different. Everyone has a uniqueness in them, which is called as personality, and that is how you should inculcate your strengths to your advantages, right? And not follow the herd in terms of, all right, my friends are doing this, or my family is doing this, or my my community might be doing this, so I should do this. You need to think for yourself what suits you better, right? And when it comes to trading, there is no difference as such. So having a detailed review, right? It could be analysis, entry point risk, or even stop loss and take profit. More importantly, it's the details that matter. The more detailed you can be with your trading plan, the better it will be for you. But the most important answer, right? Yes, not question, but answer that I get from a lot of people are that, Harsh, isn't it too tiring? Isn't it too, it's over, what do you call, we have to put in a lot of energy, we have to put in a lot of work, there is too much of work to put in to get all this done. And to all those people you need to understand that yes, trading is like any other business. It needs to have a very clear cut plan. When we're talking about trading, it is not something that we are pursuing it as a hobby. It needs to be given the right amount of energy, the right amount of dedication, and the right amount of preparation, because trading requires preparation. Yes, taking a trade does not take time, right? How much time does it take to place a trade? Couple of seconds, maybe a couple of minutes. But that is not the work that is to be done. The work is in the preparation of that trade. That is important. All right. So documenting your trade plan is very, very crucial, right? It's as good as, let me give you a reference of a commercial pilot, correct? So when a commercial pilot is ready to take off the plane with all the passengers in the flight, and when the plane is reversing, before the plane can even disembark from the platform or the runway, they need to be having a checklist. Are the all criterias mentioned in the checklist fulfilled? Even if one checklist is unfulfilled, the flight cannot take off. So if you think about trading, it is you are the pilot and trading is your aeroplane, right? So you need to be very meticulous. The pilots cannot be like, all right, today I'm being a little lazy, so let me not fly the plane today, or let me not check the plan, the flight plan today. That can result in severe consequences, correct? There have been instances in the past where, due to negligence of pilots not following the plan, the flight plan, the plane has crashed and people on board have died. So I'm just giving you the analogy of a flight plan to a trading plan. When you are taking a trade, it is your money that is on the line. So you need to be very meticulous and very clear headed in terms of the details that one should be following, correct? Now, when it comes to trading plan formats, there are numerable formats on the web pages, right? You can just go to Google and type, give me a trading plan outlook, or give me a trading plan framework. And you will get so many outlooks, so many plans based on your psychology, based on your personality, based on your risk tolerance level. So I would definitely insist that everyone start following. Even when we are providing you trading opportunities, you can make your own trading plan in terms of how you feel for that particular trade. Were you present for that particular trade? Have you placed that particular trade? What were the emotions that were going when you were placing that particular trade, how you felt when trades were hit your target? So these things can help you in understanding that yes, we are, it is a record for your own safekeeping in terms of analyzing it maybe at a future day, that yes, certain trades were taken based on certain strategies, with certain sentiment in mind, and it will help you, in your trading success. Remember, do not miss out on this crucial point. It is very important to have a trading plan. Even though people are aware that it is important, but people still neglect it. Similarly to a packet of cigarettes, right? No matter, even if it's mentioned in bold letters that smoking causes cancer, but eventually people who want to smoke will smoke. So it is the same for trading plan. But You need to be sensible, you need to be smart enough to be aware that yes, Harsh has told us about something that is very crucial and very important, and we should follow it as well. Last but not least, we will be talking about emotions. Now, who of you present in this particular community group is emotionless, right? The answer can never be zero, correct? Because we are humans and emotions are a big part of us, right? Our personalities are determined by our set of emotions. Some people are always happy, some people are always sad, some people are always you know um, aesthetic, some people are always nervous. So there are different set of emotions when it comes to different people, right? That is what creates our persona, our personalities. And for that, it is important to understand when it comes to trading, you have to be emotionless, right? We cannot be 100% emotion free. But what I'm trying to say is you have to start inculcating the behavior of keeping your emotions out of the door, especially when you are into trading. Trading is based on probabilities. We scout the markets, we analyze the different sectors and the market conditions and the individual stocks, and then based on a combination of fundamental and technicals, we are able to provide you with a conclusion that yes, there is a high probability. There have been numerous times, even after providing with high probability trades, due to external factors, right, which are not at all in our control, such as microeconomic, macroeconomic, or it could be just based on pure panic that the markets might be having. There can be prices that can be going against us. So during that time, how well can you handle your emotions is of the prime concern. People who are not able to handle emotions are the ones who majority of the times take the wrong decisions. Trading, that is why trading is always, to an extent compared to spirituality. How can you be as calm as possible when everything around you starts to turn turbulent, right? When prices are going in your favor from the place you have taken trades, you will be at cloud nine, correct? You will be ecstatic, you will be happy, you will be joyful, you will be exuberant. But let me reverse this scenario. If you have taken a trade and prices are going against, you start to get jittery, you start to get nervous, you start to get angry, you start to get sad. Some people start to go into depression. So these factors are not controlled because of the markets doing what they have to do. These factors are evolved from within us because we are connecting, or we are, attaching meaning to that particular output based on our own personality, right? And that is what emotions are basically. So when it comes to trading, we have to try to make sure that we can keep emotions at bay for as much as possible, right? We can never get to zero level, but we can at least reduce it drastically so that we follow steps, we follow a structure. Now people might ask me, all right, Harsh, what you're talking makes complete sense, but could you provide us with some tips or tricks in terms of how to keep emotions at bay? So first and foremost, most importantly, is the trading plan. If you have a clear trading plan with all the clear parameters in place about entry, about take profit, about moods for that particular trade, or the setup scenario, or whatever little details that you can provide, that itself will be a very important aspect when it comes to keeping your emotions at bay. Because when the trades are running, or when the trades are going in your favor or against your favor, you have it written in front of you. That time your brain doesn't start to revolve, unanimously. They're trying to, like, just latch onto some emotion so that you can feel better or you can feel worse. So trading plan is number one, right? Keeping a trading plan. And second is most importantly about risk management. If you can manage your risk, the intensity of suffering will reduce drastically. We also are doing exactly that. Whenever we provide you with a hot stock recommendation, when the stock market is running, it is always provided based on a position size of 10 to 15. We never inform our clients to go all in, because That is pure gambling. It's better to gamble in a casino in Las Vegas or somewhere else rather than gambling in the financial markets. Financial markets are not meant for gambling. Financial markets are meant for making money consistently, right? So I guess we have covered good points when it comes to removing emotions from the from ourselves, or keeping it at bay, at least when we are trading, correct? So these have been some important but very crucial points, right? So I hope everyone has had a good amount of understanding. Yes, we do provide you with hot stock recommendations when the stock market is running between 9:13 or 9:15 a.m. to 6:30 in the evening Indian Standard Time. But once the markets are done and dusted, we shift our focus towards learning, correct? Towards providing education. So these have been certain points which we have been talking about. Let me just give you a quick review. Sorry, a quick summary in terms of what we were talking. Oh, sorry, I just went a little too ahead. All right. So we were talking about market manipulations and stop loss hunting, basically by people who are in the FIIs and DIIs, correct? The financial investment institutions and the domestic investment institution. These are the two biggest players in the financial markets who have the funds and the liquidity to manipulate price. They cannot keep manipulating prices every day and everywhere, but they can do it at certain times where they feel that they should be doing. So we are the microbes when it comes into the ocean of the financial markets, and the FIIs and the DIIs are the big whales, correct? So you just want to be aware of this, of the size, when I'm trying to compare a big blue whale with a micro. We as traders, retail traders, are microbes. The FIIs and the DIIs are the big fishes, right? And in terms of how they are creating manipulation, whether by stop loss hunting or by the manipulation concept of manipulation itself, we talked a lot about it. And these have been certain factors which people get frustrated about, and people start taking a lot of stop losses even though they were eventually right in the direction, correct? We talked about how resistance, which gets taken out by support, again gets taken out to create structures called as manipulations, right? Where people who had taken the trades prior were correct, but just because of the situation that had arrived because of market manipulation, the prices had, people had been stopped out for prices to return back into their favor. And most importantly, we have been covering about the key points. No matter how much you learn when it comes to technical analysis, Harsh will be providing you with a lot of information, right? We are not here for just once a day or once a week. We are providing you with 3 live streaming sessions, and with every live streaming session, we try to push the boundaries of trying to provide you with more information, more value. So, but the most important aspect, before you can even think about the technicality aspect of trading, is the psychological aspect, right? So people should be focusing a lot on psychology. Let me repeat the sentence that I had said. Trading is 90% psychology and 10% mechanical work, or you can call it technical work, whatever, but the ratio is 90 is to 10. 90% being towards psychology, right? So I hope people have been very curious, and I hope I have provided you with the right amount of information. Remember, we are here to provide you with a complete open-ended question, complete open-ended based information, where we just don't want to talk about the positive aspects. We want to even highlight the negative aspects and how we can work towards improving it, right? So we can become an overall better trader, investor when it comes to the financial market. So we covered in terms of understanding the market before you trade. So be aware of the markets before you can even enter. We looked at how to look at the market from different angles, whether it is fundamental analysis or technical analysis or sentimental, how we can combine all the angles together to get the best view possible, right? Best view in terms of getting the most high probable trades, right? And assessing risk, very important, based on everyone's personality and risk appetite. it is important to be aware, right, of the different categories when it comes to risk appetite. Then we talked about risk to reward, how much you're willing to risk to how much you're willing to, get rewarded for that risk. Since markets run on probabilities and not certainties, people who enter into the markets with the assurity that they can only make money are the ones who cannot be successful in trading. So that is where risk to reward comes and plays a huge portion, right? Documenting your trading plan has been one of the most important factors that we have been talking about. Maintaining a detailed plan is going to elevate your trading success, so start making sure that you maintain your trading plan as of from today itself, right? And last but not least, keeping your emotions at bay, because only when you are able to keep your emotions at bay is when you will start to think logically, you will start to think mechanically, because trading is based on probabilities and not certainties. We want to take trades based on consistency, right? It's not taking a trade and making a lot of money only once and then losing everything again. We want to keep consistently making, and how we can take is by following a structure. So I hope all the points that I have provided to you has been of great information, of great value to you. Please make sure to arrive for tomorrow's first live streaming session, where we will be covering what the markets have been doing. Yes, tomorrow is Friday, being the 29th of November, and with Friday coming in, there will be a lot of volatility and fluctuation, since it's going to be the end of the week. So we will keep an eye on that, and we will update you with all the advancements taking place in the financial markets. So I hope to see everyone tomorrow morning. And until then, I hope everyone has a great evening and a wonderful night as well. So, everyone, have a great evening. Namaste and take care.